Let's welcome in our next guest on the show, Jyotivardhan Jaipuria, founder and CEO at Veda Investment Managers Private Limited. Jyoti, good morning. What's the first reading of the move that we are seeing in the market in relation with Fed? Is it just a relief coming in that rates may be hiked in December and not now?
Yeah, I think, there was a lot of build up to the event, and to that extent, there's nothing negative. There was no negative surprise coming through. So I think, because the event is out of the way, we've seen this market's rally. I guess, for the market, it is the easy monetary policy of central banks still continue. Until it continues, people are going to, keep enjoying that.
As far as, rate hike is concerned, don't you think that if they would have hiked the rate, they would have ended the expectation, markets would have fallen? But then, the speculation, when will it come in a very surprising manner, would have ended, and that should have also been taken as a positive?
So, from the Fed point of view, if you see, this is the first time after 2 years that there's been 3 people who've dissented to a policy. So to that extent, there were some members who were tilting towards the rate hike, but the majority still felt that they would prefer to wait. It has been like a policy where I think, central banks are very, very worried to normalize policy just now because they're not sure of the repercussions. And for most central banks, it's been let's push this down the can. But somewhere my sense is that we are coming to probably end of this easy monetary policy since 2008. Maybe we're not at the end, but we are certainly coming at a stage where things are not going to incrementally be as easy as it was. The Fed is, at the most going to be on pause, and the chances are somewhere over the next 6 months we'll start seeing a hike. There's going to be a divergence. So, probably we'll have easy monetary policies from the other central banks, but Fed at least is not going to follow the easy monetary policy path now.
So now that the Fed is behind, let's talk about earnings. The growth that we saw in Q1 was also pretty muted. It was a very muted set of expectations. It was still muted, but markets have gone up. Does that indicate rising risk in the market?
So yes, the market valuations are no longer cheap, so there's no comfort now in the market. Normally you have a risk return or a margin of safety in the market, so the margin of safety is low. At the same time, typically valuation do remain high if you're at the cusp of an earnings turnaround. And just remember, for the last 5-6 years, you've had earnings which have been very, very mediocre, low single digit type of earnings. So if we go by past cycles, then what everybody is anticipating and what should play out is a year, 3-4 year cycle where earnings are very strong in some 20% range. What we've had is it's not been coming. So people have been expecting it for quite some time now. It's not been coming, and to that extent, my view is that markets is at a stage where till you get more visibility that this earnings is really turning around, you're probably locked into a range sort of thing. You have some time correction, some price correction, and you have a period of consolidation.
But this can also lead to investor patience being tested, because from a long time we are expecting the earnings to pick up, and as you use the word cusp of earnings recovery, that has been there for a while, but it's not been visible.
Correct. So that's the issue, that now that the valuations are pricing in earnings recovery. If the earnings recovery does not come, or people keep waiting for it to come, you probably have markets which do nothing. There's possibly you could have price corrections on the way. So I think the volatility in the market will increase now. It's been like a easy one-way trend which has been going up, but I think it will get a little more volatile, and you probably, if you look at 6 months or something from now to the next 6 months, you may find that market's not done much, but at least earnings have moved 6 months forward. To that extent, valuations have got a little cheaper.
As far as India is concerned, or the as far as India is concerned in terms of arguments to invest, lower rates from here on and lower global rates will be the key argument to invest?
No, I think, see, the argument to invest in India is like quite simple. So if you look at the long-term argument, it is just, it's a country which is going to grow and grow. So, people always look for compounded growth that can, this country go over 5 years. Can we see GDP growth of 8% in India over 5 years? Can we see earnings compounding 15% over the next 5 years? So, that's the crux of the argument, that it's a country which can grow. Demographics are in place for growth. You need a lot of infrastructure. So that's the long-term argument. The, medium, like the next 1 year argument is like, earnings probably will come down. Earnings have been sluggish for a long time. There are some reforms which are taking place which makes one feel that, okay, the economy is bottomed out and is going to go up, whether it goes up slowly or, much faster than what people think is the debate. But, most people think that the trend is up. Third is interest rates have come down, and on the margin they probably will come down more. So, both monetary policy, fiscal policy, the earnings and the economic environment seem like the country is going to do well in spite of a growth which is very sluggish. So, we probably are going to be the fastest growing country in the world this year and probably the next year.
As far as consumers are concerned, again, we've seen rallies into the two-wheeler pack. We've seen rally into a lot of consumer names, in this recent leg that we've seen up move. Is it getting a very overcrowded trade where people are believing that nothing can go wrong with these companies?
So, yeah, it's a trade which is no longer new. So it's not like a totally new trade. It's like a consensus trade. People have discovered it. At the same time, that's where the first leg of growth will come. So, the valuations have done what they need to do. You're probably now playing for the growth that, I'll make share price returns which are equal to or maybe even slightly lesser than the earnings growth which we see, because at some point you'll want the valuations to contract a bit. I think the bigger delta change is going to come in the rural side rather than the urban side, because, in the rural, obviously, there have been 2 bad years of monsoon. This year's relatively been much better, and we probably end up somewhere close to like a normal monsoon, maybe slightly below. So, that's one change which will come about. The other is, in this budget, there was a little more thrust on rural than it has been over the last 2-3 years. And some of the steps the government has been taking, whether it's crop insurance, whether it's, more focus on irrigation, that probably helps the rural consumer do well over the next few years. So to that extent, I think, the rural consumer is where the bigger delta change can come. And that's why, probably when you spoke about two-wheelers, that's where the stocks are trying to, anticipate that we'll start seeing two-wheelers do well again after a gap of 2 years.
So, we've got some initial comments coming in from a lot of companies that consumer demand is decent going into this festive season. Pay commission is now behind and stocks have really rallied. Do you think majority of the benefit coming in this year because of monsoon, because of festive season as well as pay commission is factored in?
So, like I said, what we factored in to some extent is that we'll see earnings improving. And so the valuations are starting to build in earnings improving. But if, like, let's say you have a 20% earnings growth coming through, then, if you look at the same stock a year later, it becomes 20% cheaper on valuations. And to that extent, what happens is you get your returns more from earnings growth rather than from any change in valuation. So markets have factored this in to some extent, and from here on, you're probably going to get earnings growth led, share price increases.
Just a call on the consumer pack. What would you be overweight on? You mentioned the rural space. Within rural, can you be a little specific whether you would want to play it via the NBFCs in rural space, a two-wheeler company, a consumer durable company? How would you want to play that space?
Yeah, so what we like is actually some of the auto names, and this includes tractors and two-wheelers, and so that's our number one preference. There's some agrochemical companies which we think are good, agrochemical stock, irrigation. So that's the other pack we are playing to really play that sort of thing. And there's some stuff happening in rural infrastructure. So there's a lot of rural infrastructure which is doing well. So that's the other space which we are playing. we don't like the consumer staple companies. I think, they're good companies per se, but I think at these valuations, we are a little cautious on them.
Right. As far as consumer staples are concerned, also because money supply being higher or money being, slightly on the higher side, that doesn't mean that consumer staple companies' volumes would grow.
So, like I said, it's consumer staple companies also would probably do well. Like, whenever things improve, they would also do well. So it's not like they'll not do well. It's just, you have always got to weigh, okay, this is the relative valuation I have. So where do I make bigger money out of the whole thing? So for consumer staples, earnings will improve, but they're not going to change as significantly as, let's say, they would change for a tractor company. For 2 years, the tractor has not done well, and then, you have this year where tractor growth picks up, and it picks up like 13-14%. Second is you have to think of where the operating leverage will be huge. If, volumes start picking up, it would be much more for something like tractors. I'm just, throwing it as an example, versus something like, somebody who sells soaps and shampoos, because operating leverage is always very high in, a manufacturing sort of setup.
You mentioned about rural infra and you would want to buy that. Can you just be a little specific? Which companies or sectors in the rural infra space?
So, it's very tough to talk of sectors, but essentially what's happened is like now, roads are getting built in the rural areas. We are seeing, a lot of activity happening there. People are focusing on irrigation. So, there's a lot of focus on building bridges, dams, roads, irrigation vehicles. And there are companies which, probably are good at those. There are companies which focus on those. So, that's, one way to really play it, that, okay, I find some E&C companies which are focused on rural area. Their order book was quite dry for the last few years. Now that has started to pick up. You look at some companies which are into irrigation, which were struggling, and now, irrigation is starting to pick up. So there are companies in that pack which, are starting to do well. Of course, a lot of the E&C companies are doing well in other areas also, like, railways is one area which is picking up, roads is the other area which is picking up in general. So there are companies in the, infrastructure, the capex space which are doing well, though, I don't think overall capex is going to pick up in a big way.
As far as infra companies are concerned, in 2007-8, the memories would not have been that great, even for some of the companies that you mentioned or the sectors that you mentioned. So within this sector, you would look at an asset-light model, companies which do work via JV or, try and fund most of the things by equity and not by taking a lot of debt.
Yeah, so, like we've seen the whole 2004 boom to 2007-8, and then the share prices corrected. So, a lot of the infra companies are trading way below what they were at the peak of 2008. So, you've seen those stocks getting hammered. A lot of them are probably, somewhere where they are NPLs, they are half close to bankruptcy. But there are some companies which have recovered out of that, whether, maybe the debt is not as significant. So, to that extent, they're not struggling. There are some of them which are, doing pure E&C work. So to that extent, the debt really is working capital, and to the extent that they have some equity, they are able to get more work. So, there are a whole lot of range in those companies, so you can't really go blindly and say this whole sector is going to do well. But yeah, there are companies there now which are getting much more orders than what they've got over the last few years. And if they are able to fund those orders, able to fund the working capital, then I think, those are the companies which could do well over the next 2 years. You have to always look at valuation, right? So a lot of these companies have become quite cheap relative to where they were.
Good morning, Mr. Jaipuria. This is Anindya from the Delhi studio. I wanted to understand the overall picture first, because, a lot of our viewers, they understand that they probably get your views about the companies, but they want to understand, what are you betting on? Are you betting on the fact that capacities are going to improve, operating leverage is going to go up, and since new capacities are not going to come in most places, pricing power should come in, and the volume growth that will come in through capacity expansion is going to actually lead to a much faster earnings growth than one would have seen otherwise. That one can predict. Is that what you're betting on? Or are you betting on a demand side improvement? The demand is going to grow up, what is going to draw out more supplies?
Yeah, so it's like a combination of everything. So what will happen is demand starts picking up, and to some extent, you've had, let's say, a 5% demand increase, and that 5 becomes 8. You have lots of companies which have capacity already in place, and so because the demand goes up, the utilization goes up. Like you said, operating leverage is going to go up. So for me, the next 18 months, the whole earnings growth is going to be a big story about operating leverage. I don't see new capacities coming up in the next 18 months also. So this whole talk about, the investment cycle picking up, I've been very cautious on it, and my view is that's still like a story which is not going to play out unless we see earnings recovery coming, unless we see demand increase coming. So the next 18 months is going to be demand improving, operating leverage coming through, and that feeding into earnings growth. And like if we go into history, these moves can be quite sharp. They are always much sharper than what people anticipate at some point, and analysts start to, after a long spell of earnings downgrades, you start getting earnings coming in line with analyst expectation. At some point they start beating analyst expectation. So that's really the 18-month story which you're building in. Over 5 years you're building in. Once this thing starts picking up, then people will start putting capex again, and so along with like a consumer recovery and operating leverage, we also have investment cycle pickup coming through.
To use a bit of a jargon, could you just give us a little bit of granularity on rural consumption? The reason I'm asking that is that often we look at rural consumption as if monsoons have happened and therefore farmers are going to get more money and they're going to spend more. But actually it's a very stratified space of the Indian economy. There are poor farmers, there are middle farmers, there are rich farmers. There are farmers who are net sellers, there are farmers who are net buyers. If prices go up, then net sellers end up, net buyers end up losing out. If prices go down, net sellers end up losing up. So there is a differential impact of agricultural growth. If you could just take us through your own sense of how money is going to go into these different segments of farmers and what kind of expenditure they're going to do.
Yeah, so I'll just step back a bit once, and then it's one is monsoon, which we all look at, and that's the easy thing. But there are a couple of other things also you need to look at, and probably to some extent then second is the rural wages, which you have to look at. So if you see the rural wages, they've been coming down and growing at a very, very slow pace. The third has been this impact of MSP prices. So MSP prices were going up at like 8 to 10% per annum. And then, government brought it down. Partly that was to bring down inflation. So MSP prices have been going up at a very slow pace now. So this year what we are going to see is, one is that monsoons will pick up, so that helps your quantity. Secondly, the MSP price increases are not very, very high, but they are better than what they've been in the last 2 years, or marginally better than the last 2 years. So in some sense you get helped on the prices also. Third is rural wages seem to have bottomed out and they are starting to pick up a bit. So it's a combination of all these three things accompanied with the fact that allocation to rural India this year in the budget was higher than it's been in the last couple of years again. So combination of all these which helps the rural sector. Now who's going to really benefit out of this? I think the incremental change is going to come at the small and the medium level farmers, because they get benefited with the rural wages, they get benefited with some of these spending which is coming through from the budget, and they get help with they are going to produce more crops. The rich people will also benefit, but if you think of where the consumption change is going to come, is going to come from the small and the medium farmers.
So if that is the case, what would you bet on? In a little, like let's say, would you bet on an FMCG company? If a small player is spending, will they go and buy shampoo sachets again, which they might have stopped doing? Will they spend on seeds and fertilizers? Will they buy things produced by a Make Money Organics or an Insecticides India? or would they spend to buy a motorcycle, for instance? So what would that range of expenditures be on?
Yeah, so actually there are two angles here. So one is, some of these medium farmers would probably buy a motorcycle if they have more surplus coming through. So that is, a part of consumption. The other part is the government is making effort through its soil card and some of these other measures to improve the productivity of farmers. So to that extent, there's going to be more sales of insecticides and pesticides and fertilizers in the rural area. So which is like, a government initiative helped by the fact that, okay, you have a good crop, so you're more willing to spend, because at some point when the crop is very poor, you don't want to think of the longer term benefits. So, both of these segments are interesting and both will do well. Now, consumer staples, like will they buy shampoo? They probably buy more shampoos than what they used to earlier. But when you weigh that with, the share prices, then you think, okay, this is not where I think really we can make a lot more money from the share prices, because the movement will be slow in terms of growth rate. They were not affected that much, so they're not going to, the swing in delta is not going to be that big in the consumer staple companies.
Okay, let me take up some of these companies, and I know you can't talk about them as in give a view on whether to buy or them. I'm just taking them as examples. So let me take Insecticides India, for instance, that the consensus EPS for Insecticides India for FY17 is about 27 rupees and about 35-36 rupees for FY18, which means that it's trading at 20 times FY17, which is just 6 months down the line, and 15 times FY18 earnings. For a company which is almost in a commodities kind of business, is that cheap? Is that value?
Again, it's very tough to really answer some of these questions without going deep into companies. But essentially, there are two things you have to look at when you're looking at these companies. One is, can we get analyst upgrades coming through in these companies? So typically, analysts also tend to be very cautious, and even if they see the trend changing, they have a trend in the earnings, but typically they tend to be cautious, and you start seeing upgrades coming through in earnings. So that's one thing which you need to factor in, that can we see these earnings upgrades coming through. And second, a lot of those upgrades are normally led by operating leverage. So what is
Before
the
you
sort
go
of
ahead,
operating
I just want you to, I just want to ask you a question on that analyst upgrade. I'm sorry I'm interrupting you. What happens? Analyst upgrades come in and then institutional interest increases? Money flows into that counter? Is that the reason why you think that analyst upgrades are important?
No, so analyst upgrades are important for, it's not just institutional, it's for, everybody who buys stocks. The stocks are typically valued, let's say analyst is forecasting a EPS of 10 this year. So people value it, okay, we'll get a 10 rupee EPS this year. So I think, the share price should be X rupees.
Right.
And then we see that 10 rupees is actually becoming 12 rupees.
All right.
So then you say, okay, if this is becoming 12, then the share price will be X plus 20%. And then, people start saying maybe this is going to become 13. And so, the share price starts anticipating an analyst upgrade also coming through.
Okay, I get it. All right, I interrupted you with your second point. You were going that after analyst upgrades come in, you were saying something else.
Yeah, so once these analyst upgrades come in, you probably have more volumes which flow through, the operating leverage starts to pick up, and then people start saying, okay, so this year we've done much better than what the analysts expected, and to some extent then the analysts change next year's numbers also. So that valuation which one looked at 6 months earlier then does not look as compelling if you had anticipated the analyst upgrades coming through.
I'm taking another, you were mentioning irrigation. Again, I'm taking Jain Irrigation, and I know that this is a company which has had depressed earnings, it's not had cash flows, and now it's changing its model, and therefore the cash flows could start coming in. But even that is trading 15 times FY17 and 19 times FY18 based on latest analyst consensus. And there's been some analyst interest in Jain Irrigation in the last 1 month or 2 months that we've seen. A lot of reports have come in. So the consensus estimate is still about 5 odd rupees for FY17 and 6 rupees odd for FY18. So despite that, a company which has had pressure is trading at such high valuations. So how do you find value even here?
Yeah, like when we do our work, for us it is a surprise possible in this. So,
right.
And this is true for all the stocks which we cover. We just try and figure, okay, if analysts are forecasting this, can things go much better than what the analysts are forecasting? If there's a big turnaround and let's say the rural India, what is the sort of two-wheeler sales we can have, or what is the sort of irrigation which can be sold, or fertilizers which can be sold? The second thing we look at is the capital efficiency. So how much capital is there today? What is the company doing with the capital? And how likely is it that this, capital can be crunched? Maybe they're sitting on assets which are, not in the core business. So for us, it is the change in return on capital employed, the change in ROE, and the change in earnings profile, which we really look at and weigh that versus the valuation.
All right. So basically, you're betting on an outperformance right now, rather than, because earnings have been depressed, so the chances of outperformance are pretty high, right?
Yeah, so when earnings are depressed and they come off a low base, and let's say if we take this as just the broad Nifty or the broad Sensex, if we map from let's say 1991, so there have been like big periods where for 5-6 years the earnings growth was averaging 6-7%. The next 5 years the earnings growth averaged 20%. We again got into this spell where earnings averaged 5-6%, and the next 5-6 years again the average earnings growth was 20%. So typically through this depressed phase, what we found was analysts were downgrading the estimates all the time. And then once we went into this phase where earnings were growing at 20%, you had analyst upgrades coming through every time. So the recent example is if we go back to the 2004 to 8 period, analysts were continuously raising their earnings forecasts. And as they were raising earnings forecast, at some point valuations used to look expensive, and then they used to get cheaper. Then from 2008, we've seen a steady stream of analyst earnings downgrades all the way. So every 6 months we anticipate a turn in earnings which never comes.
Okay, Mr. Jaipuria, a lot of people are betting on interest rates coming down again, and therefore the credit cycle picking up. Easy money in India compared to rest of the world where the yields might tighten. But my question is, here we are saying earnings are going to go up, partly because of volumes, partly because of pricing power. Farmers are going to earn more, partly because of volumes, partly because they're going to be, MSP is going up. If wages go up, the people who employ agricultural farmers are going to pass them on. We are expecting a credit-driven demand recovery in urban area, demand recovery because of 7th pay commission, because of state pay commissions. Yet we think inflation is going to come down. To me, these seems a little odd. One would imagine that inflation should go up next year.
I think most people are not really betting on inflation coming down. What people are betting on is that inflation remains somewhere in this range. It's not really going to go down too much, but it will be around 5-ish%. And what is helping inflation is that the pressure from global commodities is not very high. So if you think of the, inflation over the last 2 years and, that whole thing where it has come down, part of it has just been that globally oil prices came down, and so that helped us to bring down inflation to some extent. Right. At some point, you want some inflation for earnings growth. So there's this always dichotomy where you want low inflation, but you don't want it that low that there's no pricing power, because then earnings is not going to come, right? So at some point you want some inflation. You don't want it at the 10% range. You'd like ideally to have this inflation in the 5% or range, so that it gives some pricing power to the company. At the same time, it gives some leeway to the monetary authorities that, okay, we are not concerned about inflation going off the roof.
Mr. Jaipuria, one final question. When we talk about, when one is taught or when one reads about how to look at growth, and there's an argument that you look at no company can grow faster in the long run than the GDP growth in the economy. But that is real GDP growth, right? When you say GDP is growing at 7%, therefore earnings should grow at that pace. In India, GDP is real GDP and nominal GDP. There's a huge difference compared to the developed world. Shouldn't one be looking at nominal GDP growth rates to kind of predict what kind of earnings growth should take place? Because those are actually at current prices.
Yeah, so earnings growth is always nominal, right? So like if you look at nominal GDP,
Right.
that's what the earnings growth is. We're
Yeah.
not looking at real earnings growth when we do, earnings growth. So a lot of earnings growth comes because of change in prices. They
Yeah.
don't just come because of change in volume. So, most people, like I look at earnings growth, I'm sure a lot of my peers also, we look at nominal GDP growth and this is the sort of earnings growth we can get.
Okay.
And generally people say, okay, if nominal GDP growth is 12, then we should probably end up with 14% earnings growth, just assuming they'll take a little bit more of the market.
So, would it be fair to say when inflation is going down in the trajectory, then the chances of, and there is liquidity as well, the chances of PE expanding is higher because, nominal growth is going to be lower, earnings growth is going to be lower, but there is liquidity, so assets are going to, stock equity prices as an asset is going to go up, so PE will expand.
Yeah, personally I'm always a little skeptical about this
Okay.
expansion of P's without accompanying in earnings growth. So, the liquidity argument holds to some extent, but beyond a point you can't have continuous increase in P's without a change in either the earnings profile or the ROCE or ROE profile, because then markets tend to get overvalued and there are lots of people who start thinking of valuation.
Right.
The comfort goes away from share prices. So share prices are always a function of, okay, how much is the margin of safety I have, how much of future growth am I already forecasting and building into share prices. And as you get less and less comfort, as you think your margin of error is going down, then people tend to say, okay, I don't really want to chase these share prices now.
Right. All right, Jyotivardhan Jaipuria, thank you so much for giving us an opportunity to pick your brains. Thanks a lot for joining us today.